Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor. Well, we are really privileged to have not one, but two of the most savvy investors with us today. I'm talking about Eric Sprott and Rick Rule, both senior executives of Sprott Asset Management. Indeed, there is a very comprehensive team of professionals at Sprott Asset Management, and I would encourage my listeners to bookmark Sprott.com. Go there and learn more about this very unique company. Sprott is a very unique investment company in my view. It sets itself apart from the mainstream firms of comparable size and caliber, I think, because Eric Sprott, the founder of the company, is a distinctly free market advocate who understands that an honest monetary system is a prerequisite to a strong and vibrant economy. And Rick Rule, who is also joining me, is also equally a strong believer in free markets and liberty. As Doug Casey has said on this show in the past, Rick is the best investment analyst that he has ever come across, and so that's a pretty high standard that is being set here. Both of these men we're really honored to have them. I should also say that John Embry, who's very well known, is also a senior member of the Sprott team. But there are so many very skilled and talented people on this investment team, so I would suggest that people should go to Sprott.com. We're going to learn more about the services that Sprott has to offer as well in the next few minutes. Well, I don't really see any reason to read the bios of Eric or Rick. If you don't know who these guys are, then you've been living under a rock for the last decade or so. But those of you who may not know these men, you can go to my webpage at Voice America website, and read the bios of both Rick and Eric. So really want to welcome and thank both of you, Eric and Rick, for joining me today on Turning Hard Times into Good Times.
Thank you, Jay.
Thank you for the comments, and I know for me, I'm very happy to be here, and we're always reaching out to people who are either like-minded or that we can convince that they should be like-minded to make the proper investment decisions.
Well, you can do your very best to try to teach people, to try to help them understand what is really going on, but sometimes it's the hard knocks of life that actually convince people. And I know that the two of you have been preaching largely to the choir, I suppose you could say. I think that you're also reaching out to a lot of other people. I think it's sad that we don't see both of your faces more frequently at CNBC and some of the other mainstream media. And, on rare occasion when I've seen the two of you on, I quickly remove the mute button and turn on the sound. But in any event, I know that you're reaching out to more and more people. I think that we are facing some of the most difficult times in my lifetime, and I'm 67 years of age, so I've been around for a while. I would like to start out with you, Eric, and ask you, how would you characterize the U.S. economy? Mostly we hear on the mainstream media it's not so good, but it's getting better, and the Fed is doing all the right things. How would you characterize the U.S. economy? And of course, yesterday we were told that the Fed is actually going to start taking away the monetary narcotic away from the veins of this economy. But just, Eric, how would you characterize the U.S. economy right now, the global economy, if you care to go there? And do you think that we're really going to see a true, honest-to-God removal of monetary narcotic?
Sure. Well, Jay, I've espoused on the economy for quite a while. I always imagined with the 2000 break in the market that, we were due for a long economic downturn. Of course, the various powers that be stepped in at the time, and they continue to step in all the time with one program after another. And as I look at the supposed recovery we're going to have every year, we always find out at the end of the year that there really wasn't a recovery, and I suspect that will be the case this year as well. There's only so far that you can cause people to go into more and more debt to sustain economic growth, and of course, back to the Austrian school, if you have debt-fueled growth, and someday you're in a position where the people can't support the debt, and or people won't lend more debt, then all of a sudden you end up with a correction, as we had in the housing market beginning in 2007. And I suspect that's the case today. As you know, debt levels just continue to rise. There's very little economic growth to speak of. There's certain sectors that have done well, for example, the auto market, but a great part of that is these new subprime auto loans that are coming out. Housing looks to be weakening off very considerably. I'm just not a believer that we can have a sustained economic growth when it's very apparent that the majority of the working people do not experience wage gains commensurate with their increase in their costs. And I use the word costs rather than inflation because inflation's underreported. But real costs are when you got to lay your money down to buy your food or your gasoline or, some service. And we know very, very well that all those costs, well, particularly healthcare in the case of the residents of the United States, that those costs are just increasing way beyond any inflation data that we point to. So I'm very bearish on the outlook. I sort of describe the whole thing as we've been in a 14-year Ponzi scheme here. We're trying all these unusual sort of financial policies to hold it together, but we're really not making any progress.
I was watching Charlie Rose recently, and he had the son of John Kenneth Galbraith on, and he was rejoicing with the fact he believed that people were no longer concerned about debt. He thought it was really that we've really evolved into something higher, and we human beings now have escaped that old notion that debt matters, and so I'm saying to myself, gosh, I don't know what hope there is if people aren't concerned about debt limits relative to income and GDP. Rick, I know that you always preface what you when I ask you a question about the economy by saying that you're not an economist, but sometimes I think the most disadvantaged people in understanding what's really going on are economists. Would you care to opine on your views of the U.S. economy and what you've seen?
Sure. I'm really a credit analyst, which maybe allows me to talk about debt a little bit.
Yeah.
What's interesting to me is my outlook is probably a little less bleak than either yours or Eric's.
Good.
I'm attracted still to the creativity and entrepreneurship in the American economy. I'm attracted to an economy where a couple of pimply-faced college kids can build a Google or an Apple. And I'm attracted to the costs that come out of the U.S. economy through technology. What bothers me is the credit that collectivist forces take for any remaining good in that economy. The only wage growth that we're seeing in the U.S. economy right now is in the oil and gas sector, which the government tries to disadvantage, not advantage. I mean, the real wage growth that takes place in the U.S. economy is taking place in the oil and gas sector, in jobs that people can afford to feed a family on. The idea that, as Eric stated, that the CPI rate of inflation has anything to do with the basket of goods that real people buy to sustain themselves is silly. They admit that it doesn't cover volatile items like food or fuel. I mean, come on, Jay, we eat, we drive. And the thing that really bothers me about mainstream economists is the fact that the CPI doesn't include tax. If I didn't have to pay the tax, I wouldn't complain so much about the index, Jay.
Yeah.
But the fact is I do. And I guess you have my comment. The recovery that we see seems an odd recovery in that what we're seeing is increase in aggregate debt levels. We are seeing, as Eric really pointed out, a stall in workers' incomes. A stall at best. I mean, people like Eric and I do fine. There's lots of cash in the system, so there's asset inflation, and you can borrow at stupidly low prices. But for real people, it's problematic.
It's problematic. The dying middle class for sure. Well, both of you have mentioned inflation, and of course the mainstream economists that we hear that are in our face every day are suggesting that the real concern here is deflation. I suspect what they're really talking about is this, without them even perhaps understanding it, what they're really talking about is the threat of this debt overload collapsing in effect, as we saw in 2008, 2009. But I'd like to ask Eric, you and Rick, what are you most concerned about? On the other hand, we have John Williams, who's worried about some sort of a hyperinflation, a Weimar Republic type of event. Are both of these extremes? I mean, are we likely to see something in the middle, Eric, or what are your thoughts?
Well, Jay, it's a great question because when you look at various places, like I look at Japan and I just think, wow, what a basket case, with all the interference in markets that goes on there. When you look at Europe, you realize that there's an economic decline going on. So now we try the new LTRO, and now we're going to get the the asset-backed securities thing going where the central bank will buy asset-backed securities, which again will be one of those situations where banks can bundle up a bunch of not-so-good loans and have a tranche that supposedly is AAA again. I mean, we're just going through the same old thing again. As I say, I'm not a great believer in the U.S. experiencing any great GDP growth this year. So, it's hard for me to get excited about what we're all looking forward to. And we keep passing the baton from one central bank to another to keep buying financial instruments. And here we have the Fed, winding down their purchases. And at the same time, the ECB's upping them. And, of course, Japan had this massive increase in buying. And I just think there's this little game of merry-go-round going on here where different banks come in at different times to support the system. Because without their support, it would be frightening if rates went higher. We've already seen, for example, sort of a mini collapse in housing here in the U.S. just recently because of a very small rise in rates. And we don't even want to contemplate what would happen if you actually had a 100 basis point or 200 basis point increase in interest rate. It would be devastating both for the individual and for the government, for that matter. And referring to John Williams, as he says, the gap deficit every year is about $6 trillion.
Yeah.
This is a $17 trillion economy that overspends by $1 trillion a year at the federal government level, and they don't even include most of the increase in unfunded liabilities. So as a mathematician where it's all going to end. I can't predict exactly when it's going to end, but the whole trend of the last 10 years is to keep denying people the promises ahead, and I include private pensions, healthcare coverage. You can just see the whole deterioration going on because we lived in this world where we always thought GDP would grow 4 to 6% a year, and now, of course, it hasn't happened for a long time, and of course the obligations therefore can't be met. So we find ourselves in a very difficult situation.
Well, Eric, do you think that we will truly see a removal of the of quantitative easing as the Fed is promising now, or do you think it could be an illusion? For example, some people are thinking that that recently, with the supposed quantitative easing, we've seen a recycling of dollars that were lent into Europe through Belgium, I believe it was. All of a sudden, Belgium had a huge number of U.S. treasuries, far more than it could ever afford to purchase itself on its books. So do you, if we're going to have a little bit of a problem, if we're going to have a big problem with a little bit of an increase in interest rates, how are they going to be able to pull this off? How are they going to be able to get back into some sort of market-driven allocation of capital through interest rates?
Well, as you know, Jay, I call them the central planners. They will try to do whatever it takes to try to keep it together. That's, I think, the bottom line of what we've been experiencing here for the last 14 years. And, whether it was the home buyer credit or the new home credit or whatever, student loans, food stamps, some way of trying to keep the economy together. And if all of a sudden that rates back up, we've seen a little back up in rates in the U.S. lately, and or if there was some crisis in some European countries, collectively these governments always make sure that there's never a credit event. We found out from Lehman when you had a liquidation exactly what could happen. And so far, anytime anybody has a problem, they're never caused to liquidate. So even the bank Espirito in Portugal, when they were in trouble, all of a sudden, over the weekend, the government comes in and takes over because they don't want these sales of assets to impact the market. Mm-hmm. What happened when Lehman. So we've never had a liquidation ever since Lehman because they won't allow it. And I guess they'll try to stay the course.
They'll try to stay the course, and I guess, when getting back to this hyperinflation idea, the real threat and these catalysts that would bring it about from John Williams' point of view is it would be a collapse in the value of the dollar hegemony, if you will, the dollars as the world's reserve currency, ability to continue to create infinite amounts of this currency unit out of nothing, that is really, it seems to me, to be the advantage that the United States has had and has abused for so many decades. Well, we do have to go to a commercial break now, but when we come back, I want to pick up on the theme of the dollar as the world's reserve currency with Eric and with Rick, and discuss the increasing unhappiness of the BRIC countries and what that might mean as a possible threat to the United States maintaining the privilege of owning the world's reserve currency. So don't go away. I'll be right back with Eric Sprott and Rick Rule. Okay, we're back now with Eric Sprott and Rick Rule, picking up where we left off before the commercial break. We look at the BRIC countries that certainly they are not happy. They've not been happy about their sense that they've not been given a fair shake in the world. The IMF, the World Bank, etc., have not given them, as they're growing, their economies are growing, they're becoming a much more, actually producing things that are needed more than the West is, notwithstanding what Rick was saying about our oil and gas production, which is certainly a bright spot in our economy. But how is this going to play out, Eric? Are we going to see? Do you think the BRIC countries now, as they're trying to set up their own financial infrastructure to compete with that of the Anglo-American Empire, do you think that this is a real threat to the dollar? And if so, what might that mean for the future of the purchasing power of the dollar overall?
Well, Jay, I would say that the best thing that ever happened to the dollar was the yen, the euro, and the pound. Maybe not. The yen is such a basket case, and the euros come under pressure here because all of a sudden this hope for a recovery just aborted. And of course, in contrast, the dollar ends up looking like it's the better of the currencies. I always take the view, if I was sitting in China and I was the largest lender to the U.S., what would I be doing here? Would I be believing the gap number, which is $6 trillion a year? And if it's $6 trillion a year, would I honestly think that I'm going to get legitimate money back, or am I going to get a default, or what is it that I'm going to get back? And I'd certainly be doing something about it. And you can, as you've commented, you can see that the moves that China's made, that Russia's made, that Brazil's made, probably not so much India, but there's definitely a move away from the dollar here. So I tend to agree with John Williams that ultimately people will realize that the emperor has no clothes, and all these currencies will come under extreme pressure.
Rick, you've mentioned, and I know that you're a champion of the fracking industry, the oil and gas production, in spite of the fact that we have a growing statist imposition against our freedoms and liberties, as you pointed out. The ingenuity of individuals and free markets, to the extent they still exist, has really helped America to a great extent. How far do you think that we're in the first or second or third inning of this play in the natural gas and fracking, or some other people, the critics of it, are saying that it could be very short-lived? What's your take on it, and to what extent will it continue to be a bright spot in the U.S. economy?
Well, certainly from a technical point of view, it has a long way to go. Two comments to that. It's very price sensitive. So, ironically, if we had a reduction in demand and then a reduction in price, we could halt fracking right away. Mm-hmm. If they can hold the economy together at even today's anemic level so that demand in the United States stays steady, they are talking about, in the plays that are the most advanced, plays like the Eagle Ford, taking recoveries up from 7% of total contained reserves to 15% of total contained reserves. And they said at the recent unconventional conference, which was held down in Houston, that the goal is to get to 30 or 35% of contained reserves. If that's true, where you're taking the most exploited shale resource in the United States, and right now you're recovering 7% of potential reserves, and you have the ability, ultimately, technically, to recover 5 times that amount, mm-hmm. that would suggest that if the government kept their nose out of the business, and if demand stayed strong, that we really truly are in the early innings, mm-hmm. In terms of the shale business. Mm-hmm. There's a lot of variability because there's local opposition to shale, for one thing, the price of oil and gas. And remember also that the price of oil and gas works at this cost of capital. both this cost of equity and this cost of debt.
Mm-hmm.
And this cost of capital, in historic terms, is absolutely unprecedented in the oil and gas industry. If you return to a more normalized cost of capital, of course, the total production costs, including your financing costs, soar. But I wanted to go back, if I may, to something that you and Eric were talking about, where you were talking about the potential weakness in the dollar and a potential collapse. I want to draw people's attention to the fact that what happens to the world might be a little less important than what happens to them, in the sense that they've already experienced a collapse of their own incomes relative to the way things cost. I pointed out on your show last time that 30 years ago, I used to stay at Motel 6s because they cost $6. When I drive past the Motel 6 on my way to the Sprott offices in Carlsbad, California, the sign says, Motel 6, $69. Now, either the utility of a room there has increased 11-fold, which is difficult, same square feet, probably same sheets, or the denominator has collapsed by 95%. The point of all this is that the impacts of inflation and collectivization on an individual basis, irrespective of your beliefs of a real total collapse, are ones that need to be considered and ones that you need to prepare yourself for, I think. That's the lesson I have. I think we sometimes do ourselves a disservice in the Austrian community by painting a picture that's bleak enough that most people don't want to recognize it, even if they do. And if we explained away things like the dollar, as Eric once said, the worst currency in the world except all of the others, the currencies together as a trap, and the pernicious trap of negative compound earnings that we're experiencing. If we take that also in the context of Mr. Obama's statement, and several of the other big thinkers, that we don't have to worry so much about the debt because mostly we owe it to ourselves. I feel like getting on the phone and saying, no, boss, you owe it to me. That's right. Not the same as we owe it to ourselves. Sorry for that rant, but I think.
Absolutely correct. No question about it. Well, let me ask you, Rick, to what extent does Sprott and the services that you provide there, do you cover the oil and gas industry, or do you have analysts on that in that sector?
We do. We have about $1 billion, I guess, exposed to oil and gas on our own behalf and on behalf of investors. We, in fact, recently have been attracted to the economics of the Canadian unconventional play so much that we're taking some of the oil and gas drilling risk on balance sheet. Thus far, to very, very, very good effect. But, Sprott's, as you pointed out, a fairly unique organization.
Yes.
In a world where our financial services competitors are trying to run billion-dollar balance sheets with $1.98 in equity, at Sprott, about 40% of our market capitalization is cash. And at the bottom of the second worst resource collapse in my career, we still generate $40 or $45 million a year in cash. So I would suggest, and by the way, credit and thanks to our founder who's on the phone, that we eat our own cooking. We don't run this like one of the firms that precipitated the 2008 debacle. We didn't accept any TARP. It probably wasn't offered to us, but we didn't need it.
Yeah. Well, there's so much to talk about, and with respect to the services that Sprott provides, and I'm hoping to learn more about it as I'm going to be visiting Sprott's offices next week, along with other media folks. But I'm wondering, I would like to just tell our listeners that there's some great information that comes out. For example, I'm looking at an article here written by Luke Groman, who I know, titled "Can the Petrodollar Survive Low Interest Rates?" And this has to do, with the whole notion of the dollar losing its purchasing power, and the Chinese and the BRIC nations, as we were saying, really sort of giving up on the dollar and looking for an alternative. And we know, at least we were being told, that the Chinese have been building up their gold reserves to a huge extent, and their silver reserves as well. It really looks to me as if Mr. Groman may be onto something here in terms of the petrodollar turning into a petro-gold system. Eric, would you care to opine on that?
Well, I could make the same comment about, for example, Saudi Arabia that I made about China.
Yeah.
Where you have invested, most of your surplus funds are invested in U.S. Treasuries. If you believe some of the data that John Williams talked about, or myself, or many other people, I mean, you just realize that there's no hope that that debt and those services can be paid off. So if you take a longer term view, rather than, what do the interest rates do today or whatever, you'd think that, they shift out of fiat-backed pieces of paper to real things should be very sustainable. So, I mean, if I was in Saudi Arabia, that's what I'd be advising them to do. If I was in China, that's what I'd be advising them to do. So you just know it has to play out. It's like, I look at a great analogy between Detroit and the U.S. government. We all knew 10 years ago that Detroit was broke, and 9 and 8 and 7. And then finally, they announced they were broke. But the die was cast a long time ago because the obligations kept going up and everyone kept ignoring them. But someday the rubber does meet the road here. And if I was an international investor and I'm looking around and I had to make a choice between physical assets and paper assets, I'd certainly be making the choice to own physical assets rather than paper assets.
Yeah, and I would mention to my listeners, there's another great article, actually a very short interview, Eric, that you did that's posted and passed along to people who subscribe to your service. It's an interview that says, get your money out of banks and into something tangible. So clearly, petroleum assets, I suppose, real estate, gold and silver, those are the kinds of things you want to exchange what are increasingly worthless units of currency into. And certainly if the Chinese are doing that and the Russians and the BRIC countries are doing it, it might be something that Americans should also take to heart. Eric, I noticed in that article or that interview that you did that you're suggesting that you have something like 70 or 80% of your portfolio in precious metals. I would like to ask you if how is that sort of divided? And you don't have to be specific about it, but I'm guessing that's not all in the physical. You probably included in that number your investments in the mining shares as well. And yes, am I correct in that assumption?
Yes, Jay, that's correct. That I invest in our own funds, our silver equity fund, our gold precious metal fund. I have a big investment in our energy fund. And I own lots of physical gold and silver. I couldn't even tell you what the breakdown was.
Yeah, it's not important. I just wanted to, because the mining shares did very, very well the last time we had a significant decline in the U.S. in the 1930s, of course. And I'm wondering if either of you are concerned about confiscation of gold in the future. Is that something that you think about, worry about? Rick, what about you? Start with you.
I think there are other ways for them to steal that are easier. They can increase taxes and fees. They can continue to punish savers with artificially low interest rates. I'm less concerned about them confiscating gold and silver. Of course, their actions are unimaginable, Jay.
Yeah.
So maybe I'm deluding myself.
Yeah.
I just look at how among ordinary Americans, the actions that Congress has taken to steal from are so popular that I don't think they need to confiscate precious metals. I don't think that precious metals, in the context of investable assets in the United States, yet merit a comma. I think that's going to change, and I think it'll be fairly interesting when it does. But I suspect that they'll continue to find more palatable ways to steal, rather than doing things like confiscating gold and silver, or, by the way, this is a concern of many of my clients, confiscating your IRAs. I don't think that'll happen.
You don't think it will happen?
I don't. I think it's too easy for them to continue to steal in other fashion. I mean,
I see.
Jay, they had this really cool thing called the printing press.
Yes, that's true.
If quantitative easing, let's call it what it is, counterfeiting, were really such a good idea, they ought to know that the private sector can do anything better than the public sector, and they ought to let you print J's and me print Rick's and Eric print Eric's, and let the currencies have it out in the market. The easiest form of theft that they have doesn't require any kind of gun at all. it really is digital. They just continue to debase the currency, which is, I think, a crime. I think it's fraud.
Well, it certainly is fraud, no question about it. But Eric, what are your thoughts on that idea of confiscation? And also, my idea is that silver and platinum group metals even less likely to be confiscated because they are indeed needed for industrial purposes more so than gold.
Sure. Well, here's what I think, Jay. I think if it came down to a massive currency crisis where countries needed to back their currencies with something real, where people just didn't trust the fiat currencies, then that issue of confiscation might come back on the table. I mean, I'm a great believer that the powers will do whatever they want to. Mm-hmm. I think it's a risk, and that's why, most of us in the gold business always suggest that some people have some of their precious metals out of the system so that they can protect themselves. And as you may recall, even in, I think, the 30s when they confiscated, I think a lot of people didn't hand in their gold.
Right.
Now, it took them a long time to realize on it because it was another 40 years later before they took off the restrictions on gold. But nonetheless, it was an appreciating asset when they let it trade freely. So I think it could happen. I mean, I'm not predicting it's going to happen, but desperate people do desperate things.
Well, that's for sure. And so common people like myself and folks that are of average means need to have a way to protect their wealth and their families, and that's what we're hoping that you at Sprott can help us with. I'd like to just sort of wind up our conversation by asking you, Eric, perhaps to give us an overview of the services that are provided by your company.
Sure, and I'm sure Rick will help out because Rick has a suite of products that certainly extends our line.
Yes, please. Both of you, Rick. Yeah.
We have the metal trusts which trade on the NYSE. We have the gold trust, the silver trust. We have the platinum and palladium trust, which Rick is very involved with. We have created an ETF called the Sprott Gold Miners Index, which was listed just a while ago in New York, which is taking a different approach to the composition of securities in that, which we think will have an opportunity of outperforming the other competing trusts. We, of course, in Canada have our precious metals funds, whether it's we have a silver equities, we have a general precious metals fund, we have an oil fund, and I know Rick has a suite of products that are somewhat different than ours and also include some of ours. Maybe, Rick, you could comment on that.
Yeah, go ahead, Rick, please.
Sure. In both the United States and Canada, we have a private wealth division where we will handle individual accounts for individual human beings with products including our own, but others. In the United States, we have segregated managed accounts where if you don't want to manage your own money, we will manage it for you, at least in precious metals, natural resources, and deep value. We also, in the United States, for accredited investors, manage what are, in effect, private equity pools in natural resources and precious metals, debt and equity. We have a full range of products, really. I should say we have an institutional group that manages money for some of the very, very, very largest institutions in the world, which is important to tell callers on your radio show, because the consequence of the scope and scale of Sprott, almost $10 billion in assets under administration, assets under management, and assets on call from large institutions, gives individual investors who have an account with Sprott access to the same sort of brain trust that manages for these very, very, very large investors. And the fact that we have a suite of products, which includes physical precious metals trusts, equities, and debt, all throughout the natural resources sector, gives us a very broad perspective on these markets, a perspective that isn't available to most organizations, which are either focused on resources but are smaller than us, or more importantly, are generalist investors who don't have the depth of experience in one sector that might be appropriate for an investor who listens to your show, Jay.
Mm-hmm. Well, I think it's really fabulous, and I must confess that I haven't kept up to date with all that's going on at Sprott. I do look forward to meeting both of you next week in Toronto and your team of people that you have there. It is really a very impressive group of people. talented professionals that you have on staff there. And I tell my listeners again, it's Sprott, SPROTT.com. Go there to learn more about about all the services that are provided, and I hope to be talking more about those on this show going forward into the future. Before I let both of you go, though, I'd like to just get one last question in, if I could, concerning the precious metals. Rick, I think you've gone on record recently on this show saying that you, by far, prefer platinum and palladium. Is that correct still?
Yes, it is. I own, personally, relatively large amounts of gold and silver, and of course my life is leveraged to precious metals through my involvement in Sprott. But I shouldn't say that. The aggregate amount of gold and silver I have is larger than the amount of platinum and palladium. But
sure.
The truth is that my recent purchases over the last year and a half have been driven by platinum and palladium simply because of supply and demand fundamentals. I don't know where the platinum is going to come from to keep the skies from getting smoggy through catalytic conversion.
Yeah. Yes, and Eric, I know you've been bigger on silver than gold in the past. Is that still true? You've been more bullish on silver than gold?
Well, Jay, it is, and that's because I tend to focus on gold and silver, whereas Rick, of course, has taken up the sort of the standard bearer for platinum and palladium, and I totally agree with what Rick says. I keep wondering, whether Mr. Putin someday comes out and says we're not going to export any platinum and palladium, and could all hell break loose. But, we're pushing him pretty hard here, and I'm not predicting that he'll do it, but he certainly has some cards to play. And I've liked silver simply because I think at a ratio in price of 66 to 1, it's totally ridiculous. I think both prices are ridiculous. And when I think of even just last year when India came in and bought an extra 18% of the silver market because they couldn't buy gold, and the price went down, I just find it so unbelievable. And the same story with China, which from 2011 to 2013 bought an extra 25% of the gold market, and the price went down.
Yeah.
I just have to shake my head every time I see these things. Of course, the fundamentals don't seem to work anymore.
Well, we have on my show very frequently David Jensen, who believes that it's totally explainable by the fact that you have a fantasy market called in London and New York, which are really paper markets, and you have a real market that's taking shape more and more in Shanghai that is a physical market. And as to your point, Eric, that you think Putin might stop exporting, it's my understanding that, in fact, the Russians have come out and said that they're no longer exporting, but they were going to be buying some platinum on the market. I don't know if that's true or not. But another point that David makes frequently is that we are seeing quite a premium for these metals in the physical markets in Shanghai, and I don't remember what they are, but not so much for gold, but for silver, 12, 13, 14%, something like that, and platinum and palladium even more than that. So I think that ultimately it seems to me that what we've got is a casino kind of market in the futures markets, whereas initially they were based on real product being sold, and now it seems to be more of a mechanism for the lack of price discovery in these metals, which is, I believe, part of the game that's being played. But then, that's another topic, and we've really run out of time. I want to thank both of you so much for your generous sharing your time and your insights, and I really look forward to learning more about Sprott and passing on your good services to my listeners in the future. Thank you, both of you, for joining me today.
Hey, Jay, thank you very much. It's been a pleasure, and we're very, of course, cooperative in the sense that there are so few voices out there that seem to be away from the mainstream, and we appreciate all your contributions.
Thank you very much, and thank you, Rick, as well, for joining me today.
Thanks, Jay. Look forward to seeing you next week.